Great. Okay. Good evening, everybody, once again. And thank you for joining this session. So, we're going to speak on hybrid mutual funds and how you can use hybrid mutual funds to lower the volatility of your portfolio. How you can cushion your portfolio, especially when you are facing volatile markets, or especially when you don't have a long-term uh, duration in terms of your investments. You want to invest for the shorter or medium term. Then hybrid mutual funds are a good way of lowering the volatility of your portfolio. Hello again. First of the disclaimer, not a SEBI registered analyst, so whatever discussion we are doing here, it's not trading or investing recommendations. It's purely intended for educational purpose. Hello. So basically, we are looking at around six hybrid mutual fund categories, and conservative. I just list it out here. Conservative hybrid, which has a equity portion of around 10 to 25%, and then we have something which is called the aggressive hybrid. So the aggressive hybrid has a equity portion of 65 to 80%. Then we have something which is called as balanced advantage or dynamic allocation. Okay, what this means is that the fund manager has the freedom to position the fund towards debt or towards equity, okay, depending on the market condition. So the equity portion can be 65% and the remaining would be debt, but the net equity portion, which means there will be hedging, right? Net equity portion meaning there will be hedging derivative instruments, and they will manage the equity from 25 to 40%. They can manage the equity level or the equity exposure to somewhere between 25 to 40%. That is the balance advantage. Then we have something called as the multi-asset allocation fund, okay, which means that there are at least a minimum of 3 asset classes in one single fund. Okay, multi-asset allocation meaning there are at least 3 asset classes in one single fund. Yeah, the state of the MFs is as good as the state of any other asset in the market, right? The market MF is not isolated from the market. Yeah, doom and gloom. uh, yeah. Okay, and then we have something called as arbitrage fund, which is actually equity fund, but they are in hedged positions. Okay, so arbitrage funds have the permission to deal in trading between cash and derivative markets or different markets, and then so they do this hedge trading, which is the arbitrage funds. Then last of all, we have something which is known as the equity savings fund. Okay, again, the equity portion here is 65%, but the net equity exposure is brought down to 25 to 35%, by hedging the entire portfolio to that extent. Right. Now, the position of MFs is the same as the market because the MFs invest in the market, right? And so it cannot be isolated from the market. And also because of the interest rate rise, the bond funds or the debt funds are sensitive to the interest rate. And you see that medium term to long term debt funds have also lost value since the RBI has raised the interest rate. Even the shorter term funds have also lost value, but they will pick up very soon, right? So in June, another rate hike will be there. So there will be a short term erosion in the value of the debt funds also. So yeah, we are going to see the basics also. We are going to see each of the category in detail. I'm then just trying to tell you that the mutual fund is not isolated from the stock market, right? And the debt funds, they are also sensitive to interest rate risk. So So if whenever you're investing in a debt fund or say a hybrid fund or an equity fund, you have to understand that the mutual funds are not insulated from the market. Of course, the market sentiment will affect the mutual fund performance also, right? Okay. So first of the conservative fund, what is the conservative hybrid fund? Okay, like we said, the equity is only 10 to 25%. That's it. So, and the debt portion is 75 to 90%. So the maximum portion is in debt, while equity exposure is very low, right? That is the conservative hybrid. And because this is primarily a debt fund, okay, so the taxation of this fund is as per the debt norms. And the debt norms is taxation is the long-term capital gain will be for 3 years. That means if you hold for 3 years or more, then any gain that you accrue on that fund will be considered as a long-term capital gain, and the taxation will be 20% tax on the profit with indexation benefit. I hope you know what indexation is. If you don't, I'll just clarify. Indexation means the cost of the purchase of the fund will be adjusted to the inflation level, So income tax department comes out with figures on which you can adjust, right? So you increase the cost of purchase for inflation, and that is known as indexation. So when you increase the cost of purchase, obviously the profit amount will come down, right? And so your tax will also come down. And so that is the benefit of indexation. And for that, in a debt fund, because this is a primarily debt fund, the majority portion is in debt, and therefore it will be taxed as per a debt fund. So long-term capital gain will be considered for a holding of 3 years and more, and a short-term capital gain will be considered for a holding of less than 3 years. And if it is a short-term capital gain, it will be taxed as per your income tax slab rate. So if you're in the 20% slab rate, it will be taxed at 20%. If you're in 30% tax rate, it will be taxed at 30%, right? So that's how the tax will be. And the conservative hybrid. So because this is in debt, okay, the fluctuation in this, what we are trying to understand here is that in these kind of funds, the volatility is low. So if you want to cushion your overall portfolio volatility, these are some of the instruments that can be used depending on the amount of time that you are willing to invest in, and also your overall asset allocation strategy, right? And then there is something which is called the the aggressive hybrid. Okay, conservative hybrid. Now this is the aggressive hybrid. So in this, the equity portion is much more. It is 65 to 80%. So you have out of 100 rupees, you have 65 to 80 rupees allocated to equity, and the debt is only 20 to 35%. So the debt portion will cushion your volatility to a certain extent, to a minimum extent, and 65 to 80% is still allocated towards equity. Okay, so 65 to 80. Why we say 65 to 80? Because the fund manager has the freedom to, if the fund manager feels the market is undervalued, it can go up to 80%. And if they say markets are expensive, they can come down to 65%, but not below that, right? So equity is 65 to 80%, debt is 20 to 35%. And because equity is a minimum of 65%, this fund will be taxed as per the equity fund norms. Okay, and this is the rule which the Income Tax Act has set up, which is that if a mutual fund is investing a minimum of 65% in equity, then it will be taxed as per equity. And if it is less than that, then all other funds will be taxed as per debt norms. So what is the equity taxation norms? The long-term capital gain will be for 1 year or more holding, right? If you hold the fund for 1 year or more than that, then it will be considered as a long-term capital gain. The tax on the long-term capital gain is 10%, and 1 lakh is exempted. So if you have profit till 1 lakh, no tax on that, right? But anything that is above 1 lakh, 10% on the long-term capital gain above 1 lakh. And if it is a short-term capital gain, meaning that your holding period is less than 1 year, then it is a flat rate of 15%. So you see that equity taxation has a lot of benefit compared to the debt taxation, right? So equity, you have less holding period, just 1 year, compared to debt you have 3 years. And equity, you have 1 lakh exemption, and over and above that it is just 10% flat, and short term is 15% flat. But here in the debt, you have short term capital gain as per the income tax slab rate. So whatever is your slab rate, if you are in the 30% bracket, you'll be taxed at 30%. And you get after and this one is the holding period is 3 years, and you get 20% tax here. Of course, you have the indexation benefit here in the debt norms. So this is the aggressive and the conservative hybrid. Basically, it is up to the the exposure which the fund has towards equity. That's how it is positioned, right? So you want to understand how much exposure you want to equity and how much exposure you want to debt, and what are the taxation norms that will apply. So accordingly, you can select your hybrid fund and can select your overall asset allocation strategy. Okay. So then we have something called balanced advantage. This is a dynamic asset allocation. Balanced advantage meaning the fund manager has total freedom to move from 65% to even bring down the equity to 25%. But it will not be by selling all the equity. It will not be by selling the shares, but rather it will be through hedge positions. So they will take counter positions in the derivative market. The equity, they will keep 65%, minimum 65%, but they will keep counter positions in the derivative market, by which they will bring down the net equity exposure to 25 to 40%. So this is giving you much more cushion in terms of volatility, because the fund manager has the ability to bring it down to 25%, even up to 25%, by taking counter positions in derivatives. But the advantage here is that because the equity is 65%, it will still be taxed as per the equity norms. So think about this. So by using derivatives, they are bringing down the exposure to 25% or to 40% between that bracket. But in spite of that, the taxation can happen as per the equity norms, because the cash market equity is a minimum of 65%. So that is your advantage when you are doing a balanced advantage fund. Balanced advantage, or it's also known as dynamic asset allocation funds, right? If you want to look at it, I have this the moneycontrol.com. You go to mutual funds screener, right? And you come to this hybrid fund, right? Hybrid. And then you look at, there's this conservative hybrid. So click over here, conservative hybrid. And you have all the conservative hybrids over here, right? And you can sort it based on return or on ranking. So the conservative hybrid has, over the last 1 year or so, given approximately 6 to 7% return, not much, 6 to 7%. So it is not isolated from the market sentiment. But of course, if you see the YTD loss over here, which is actually 2%, 1%, like that. So if you have a completely 100% equity portfolio, probably your portfolio would be 15 to 20% down. The Nifty is 15% or more down. But in that space, the conservative hybrid fund is only 2% down. So this is lessening your volatility to that extent, right? And let's look at also the aggressive hybrid fund here. So it's got 65% in equity, and sorted according to the 1 year returns. And then you have approximately 9 to 11, 9, 10, 12% returns in the last 1 year. Okay, there are some exceptions over here, but the normal returns will be around 9 to 12%. If you see YTD returns, except one fund here, it has got 13%. It has performed badly. The other funds have around 4 to 5% negative YTD. YTD is year till date. Okay, so the calendar year 2022. So this is the negative returns on YTD funds, which is only 4%, while the market has fallen by 15%. Right? So that is how you're cushioning your volatility even by using a hybrid fund, because your exposure to equity is 65 and you have some portion of debt included in that fund. That's how you lessen your volatility. Okay, let's look at balanced advantage fund. Any advantage in balanced advantage? So this has given, in fact, these returns over the last 1 year are very negligible. Usually, balanced advantage funds give you a return of 10 to 12%, right? That you can see it here in the 2 years time frame. But over the last 1 year, the returns have been negligible, 5%, 7%, and so on. And again, you see the volatility, the YTD, the volatility is somewhere between 3%, 4%, 2%. In that manner, again much less than the market volatility. This is the advantage that I'm talking about, how to lower the volatility of your portfolio by using the hybrid mutual funds, the hybrid mutual fund schemes, right? So when the market has fallen down by 15%, these funds have only fallen by 2 to 5%. Okay, some more categories, which is the multi-asset. The multi-asset, as we said earlier, has at least 3 asset classes included in one single fund. So you have equity and debt for sure, and the third asset will be either gold or real estate. Mostly it is gold, right? And the minimum allocation to each asset class is 10%. So you have minimum 10% gold, 10% debt, 10% equity, but otherwise it can be somewhere between equity and debt, right? And of course, this is taxed as per debt norms, because equity will not be 65%. And so this will be taxed as per the debt norm. So your long-term capital gain will be only after 3 years. Right. I want to look at multi-asset funds here. Again, coming to multi-asset allocation. Sorted on 1 year returns. 5% to 8% on an average is the return in the last 1 year, right? In the last, for 2 years, of course, it has performed much better. But look at the volatility here. Okay, 3%, 4%, 7%, 2%, 5%. That's the lower volatility, much lower compared to the market scenario. Okay. And then we have something called the arbitrage funds, which is, of course, again, equity is 65%, but it is a totally hedged portfolio. And they are permitted to use arbitrage or derivatives for trading opportunities. So they take a position in one market and take a counter position in another market. It can either be cash and derivatives, or it can be different exchanges or whatever, So they are permitted to use this. The arbitrage funds are permitted to use the derivatives for trading opportunities, but it will always be totally hedged, okay, counter position. And that's why you will see, even though equity is 65%, you will see there is very less volatility in arbitrage funds. But of course, the returns are not very huge because in today's world, with a lot of technology and algorithms, there are hardly any arbitrage opportunities, right? And to the human eye, there is hardly any kind of an arbitrage opportunity. Will not get it because the algorithms are too fast. And it is only through the high-end algorithms that this arbitrage takes place, right? So you see the returns are pretty minimal on this, but you also see that in the YTD, or the 6 months and 3 months, and there is no negative return. There is no negative return at all, right? Even though on a yearly basis the returns are quite minimal in this case, but there is no there is no negative return in this case. So these are the type of funds that you can use to park your money for some time. Let's say you are in an extremely volatile market and you want to reduce your exposure to equity and reduce your portfolio volatility and park your fund somewhere, so that it doesn't lose value. These are some of the things that you can take on, and There is no volatility here. See, YTD, everything is green, nothing is, it has not lost value at all. The reason being that it is totally hedged. It's totally hedged on both sides. So the returns are low, but this is good for cushioning your volatility. And of course, because this is equity 65%, and so the greatest advantage over here is taxed as per the equity norms. Now, if you put, let's say, money you want to put for 1 year, and you put in short-term bonds, you will be taxed as per debt, right? You'll be taxed as per the debt. So in case you withdraw in 1 year, and then you have short-term capital gain applicable to you. But in case of arbitrage, if you take for 1 year, then it will be taxed as per the equity norms. So we discussed that last time, Yash, when we were discussing the equity checklist. There are some major things that we can look at. One is, of course, the returns that we can look at, right? The second is your risk ratios. So you want to look at risk adjusted return, right? So you have your Sharpe ratio, beta, standard deviation, and all of that, alpha and all. So you can look at these matrices, which can help you to understand what is, like, if you have two funds of a similar category, what is the Sharpe ratio? The Sharpe ratio has to be higher. If the Sharpe ratio is higher, then it means that that fund is giving a better risk adjusted return. For per unit of risk, it is giving a higher return. So, or else you can look at beta. Okay, beta is a measure of volatility. So if the beta is 1, that means it is the same volatility as the market. And if the beta is less than 1, it is less volatility than the less volatile than the market. Okay, that's, you can look at beta, right? And you have alpha and trainers ratio. All these are risk ratio. The alpha is the is the return that the fund has generated over and above the market. So, and then if you have a good knowledge of the stock market, of what kind of stocks are good and what kinds of stocks should be, so you can look at the portfolio of each particular fund. Let's, for example, just I'm taking this one fund and see the portfolio. What is the fund holding? Look at the portfolio and look at it, whether it suits your investment objective or not. Okay, whether it suits your risk profile or not. So this fund has invested in HDFC, Reliance, Adani Ports, so on and so forth. So these are the top 10 stocks in the portfolio. You can also view the complete holding here. The top 10 stocks are 19.46%, and the top 3 sectors are 19.43%. What is the large cap? 41%, mid cap is 17%, and small cap is 3%. So does this suit your risk profile? Is this what you're looking for, right? And then you can have an understanding of whether you want to invest in this fund or not, right? Look at the scheme details. What is the exit load? If there is any exit load, what is the expense ratio, right? And who is a fund manager? Who is a fund manager? How long has he been there with this fund? How long has he been managing this fund? You can look at the past performance and see how he has been managing this fund. That is some of the micro details that you can look at before you decide whether you to invest in that fund or not, right? And then you have exit load. In this case, I think there is, yeah. So in this case, it is 0.25% if the fund is sold before 30 days. So after 30 days, no exit load, right? So you look at this. And the AUM, assets under management, how much money the fund is managing in this particular scheme, right? So those are some of the things that you can look at. So we did that. I think it was last Saturday or so. I think we did that stream, which I titled is as equity mutual funds, a 5-point checklist, right? So in that stream, I have discussed in detail about all the risk ratios, the performance, and then the portfolio and all other things that you want to look at. So I have discussed in detail in that stream. Maybe you would like to check it out. It's the title is equity mutual fund, 5-point checklist. I think I did it last Saturday. Then finally, you have the equity savings fund. Okay, and I like this fund, the equity savings fund, because it invests in equity and debt, and plus it also uses arbitrage, right? So you have equity at 65% minimum, and then you have debt at a minimum of 10%, but you have a net equity position of 25-30%, which is the arbitrage or the derivative hedged positions, right? So in spite of having net equity position of only 25-35%, so that means 65%, is out of 65%, you have only 25-35% net equity exposure. So around the 30% or more is actually hedged, right? So that makes it very safe, and then taxed as per the equity norms. In spite of this, you are taxed as per equity norms. So let's look at equity savings funds, how they have performed over the last 1 year. So over the last 1 year, around 7-8% return, 6-8% return, and again, a very less volatility, 2%. And in some cases, 0.8%, 0.4%, 0.91%. That is the negative returns YTD. So much, much less than the market. And at the same time, around 6-7%. So almost, keeping up with the inflation, almost. So these are good funds if you want to park your fund for some time, especially in this kind of volatile markets. And then you have to you want to slowly allocate more and more larger time period, say 1 or 2 years. Then these are the kind of funds that can help you to park it with a very less amount of volatility. Yes, I want to do more of a chart analysis, but I'm waiting for the market to improve. Okay, and there's one more thing I'm waiting for, because I'm going to bring you my I'm going to when I do the next chart analysis thing, I want to bring it in a new way. So if you're losing money, you want to park your funds somewhere like this, or park your funds in kind of blue chip stocks, defensive stocks, so to say. uh, you can do that. Yeah. So money, if your money is already in equity, then you can switch, right? You can switch, right? If your loss is too much, then see, you have to control your loss. Okay, you don't make too much of profit, it is okay, but you can't make too much of loss in the stock market, because if you make too much of loss in the stock market, then you're out. Yeah, you're out of the game. If you're out of the game, that means you cannot play the next inning. And so you got to have money saved to, if you want to play the next inning, right? So, and therefore you have to you have to what do you say, क्या कहते हैं? You want to save your capital, right? And so if you're losing money on stocks, and if you're dud stocks, then please switch to, if you want to keep exposure to equity, then switch to defensive stocks. I think we did remember we did a stream on the RBI interest rate hike, and how to invest in the interest rate hike. So in that, I talked about how to allocate your money towards defensive stocks, right? So your defensive stocks will be something like FMCG sector, right? Things like that. So you move your money to that, or even public sector units, so which are giving high dividend, right? So those kind of stocks, you move it for the time being, so that at least till the volatility is done, you're able to save your money. Or you can do something like this, what we are discussing right now. So this is also some measures to decrease your volatility. You don't have to hold it forever. You can you can re-enter later on when the market improves. You can re-enter the same stock later on if you want to, but you don't have to just keep on losing money. At somewhere you have to put a boundary. Yeah, so what I was saying was, uh, Jet Airways, you mean the stock? Is there a stock? So I don't know if there is a Jet Airways stock, but usually all the airway stocks, Indigo, Go Air, uh, they are not doing well. They're not doing well. Okay, so yeah, what was I saying? Yeah, I was saying that about the next chart analysis thing that I was wanting to do. I want to bring something that is new, okay, and that is analyzing portfolios. That's what I want to do, especially the pain point that you are saying, that when you look at your portfolio, you don't know what to do. So that's how to plan your portfolio, and I want to analyze that with you, right? So it's not my something that I put on, but something that you bring in, and then I'll give my comments on it. That's what I want to do. So I'm waiting for some things to happen. One, the market to improve. Second, we also want to put up a giveaway sort of a thing, and one auction. I'm waiting for both of those things to happen. We'll do that, you know ASAP. And in the meanwhile, please, if you are bleeding on your portfolio, then cut out those stocks which are giving you the maximum loss. Cut out those stocks and put them into blue chip, right? Put them into blue chip, or put them into things like this, right, where you can park your money till the time the volatility is done and the market sentiment improves, right? Then you can re-enter again into equity, but you don't have to keep on bleeding and don't do anything about it, right? So that is my suggestion to you. Please take action, and cut the losses. Cut the losses, otherwise you will not be there to play the next innings, right? Right. Any other questions? So that's what we wanted to speak about today. So we have conservative hybrid, aggressive hybrid, balanced advantage, multi-asset, arbitrage, and equity savings. So all of these hybrid funds, depending on whether you want equity or debt, helps you to cushion the volatility of your portfolio. So yeah, again, do connect with me at www.capitalworx.in, and for anything that is related to mutual funds or equity or insurance, portfolio management, and training. And yeah, so that's my email also. You connect with me on LinkedIn or email also. The stock market will recover, but the stock market will take time to recover. So that will be around, in my assessment, at least the interest rate hike that is going to come in June, and the inflation scenario. So at least 2 to 3 quarters. So you're saying 6 to 9 months. So in the meantime, the market will move up and down. It will go up, will come down, will go up again, will come down again, and it will move in that range bound fashion. You will not be able to see much profit in your portfolio. So this is the time to accumulate one this is the time to accumulate good stocks at lower prices for your long term portfolio. And when I say long term, it's for 7 years, 10 years, and so on. Good stocks at very low rates. That is one. Second point, you want to navigate the volatility, and don't make huge losses. Even if you're not making profits, it's fine, but you don't make huge losses. Okay, that's where you will be blown out of the system. You will not be there to play the next innings, and that's why you need to protect your capital. And that can be done by what we discussed today in mutual funds, or you can put it to defensive stocks, like we discussed in the stream when we had the RBI interest rate hike, and how to invest after the interest rate hike. So we discussed it over there. And so that's what you want to do. Cut out the losses and cushion your volatility, so that you are in the game. Right now the matter is about survival, right? You survive the other 6 months to 9 months, survive in the market. That's what you want to do. Okay. Any other questions? Okay, great. So that's all I wanted to say today. And then, yeah, we'll see you soon. Yeah, any questions? Okay, fine. Rakesh Junjunwala, I don't know. Is he investing in Jet Airways? I don't know. I don't know. And even if he is investing, that does not mean that we also blindly invest, right? So he has the kind of information that I don't have, right? Or he may be knowing something that I don't know, and so I cannot blindly follow because some celebrity investor is doing. I cannot blindly follow that. I don't know. I don't know. See, there can be a news about a lot of things. Right now, Jet Airways, they are reviving, so they are putting it out in the media, right? They are posting pictures and things like that. So it's media. The things that come out in media, just you want to remember that they can very well be planted. Okay, they are good PR firms who are doing their job very well, and so everything that comes out in media does not mean that we have to follow that and we have to invest that and all. And for there are 6,000 or more listed companies on the stock exchange, and so you have ample amount of opportunities. Let Jet Airways make some profit, right? And then you want to get into it. If let them be a profitable airline, and then we'll come and invest in Jet Airways also. What's the hurry? Tata Metalinks, I haven't seen it. I haven't seen it. I haven't seen it. Maybe we can do it in the chart analysis session. But I'm taking a break this week, so this week we'll not be having the chart analysis. So next week I'll not be having the chart analysis. I'm taking a break, and then going forward we'll have two sessions in a week. We'll do that. Okay. Uh, Thank you for joining again, and thank you very much. And see you soon. Bye bye.